Hello everybody and welcome back. Today with me there is Tricia Wong from Eastspring Investments. Tricia is a fixed income specialist and client portfolio manager. Welcome, Tricia.
Hello, Thomas.
Tricia, central banks all over the world are reacting in a very different way on the COVID-19 pandemic. How is the situation in Asia? How are Asian central banks reacting?
In Asia, while we are not actually seeing those unlimited quantitative easing programs that are announced by central banks like the US Federal Reserve, the direction of monetary policy in Asia is also undoubtedly towards easing. If you've actually seen the policy actions announced thus far, you will see that policy rate cuts have been announced, and also there are also various measures being announced to support the liquidity of the domestic financial system. However, because economic conditions vary in each country and where they are in terms of the infection curve, the COVID-19 infection curve also differs. The extent and the form of accommodation can differ from country to country. So, for example, in Taiwan, you do get a policy rate cut of 25 basis points. In India, you get a policy cut of more than 100 basis points. And the Reserve Bank of India have also resorted to other monetary policy tools like the Operation Freeze as well as LTRO. But having that said, we do think that most of the policy rate cuts are already behind us, given that we are gradually coming out of the effect of COVID-19.
So especially China seems reluctant to more drastic fiscal monetary measures. So what is the reasoning behind it?
I think a key reason is domestic factors. We all know that for their financial system, they are highly leveraged. The debt to GDP ratio on an overall level, including companies as well as government, the debt levels have actually grown very much over the years. So the extent that they could pump prime the economy through increase of credit, is increasingly more challenged. So which is why they are actually approaching this stimulus on a more gradual pace. Although we do also see them incrementally stepping up in terms of the fiscal as well as monetary policy easing. For example, following the MPC meeting in May, they also announced further fiscal support for the economy.
So what role do currency considerations currently play in your portfolios?
So for Eastspring Investments, we do run a range of portfolios, from those that are hard currency denominated, meaning the US dollar denominated bonds, and those that invest mainly in local currency bonds. So for those hard currency denominated bond strategies, like those Asian dollar credit strategies, the currency consideration comes mainly from bottom-up perspective, meaning we want to assess how much mismatch in terms of dollar liabilities towards their revenue compared to their revenue, and whether currency fluctuations could then actually impact the ability to service their foreign currency debt. But of course, the currency fluctuation would also be a gauge for us in terms of where the risk sentiment is, and whether that would also have a follow-on impact on the demand for Asian dollar credit. But for Asian local currency bonds, those bonds that are denominated in local currencies, currency consideration is an active source of value add. So we do look at the outlook for individual Asian currencies versus US dollar, which is the base currency of the portfolio, by assessing the prevailing market themes, as well as the external as well as the domestic fundamentals. So that we can see whether there's any tactical as well as longer term currency opportunities, whether we are looking at potential appreciation over the short or medium term for individual Asian currencies, and that could be an active source of value add for this Asian local currency bond.
So especially the Asian high yield spreads have widened dramatically. What are you expecting for the default rates?
the Asian high yield corporate credit spreads have widened significantly, especially in the March period where there was actually a global market rout when people were concerned about the impact of COVID-19. So we do think that the market sell-off has been very excessive. And at one point, the credit spreads actually went up to more than 10,000, was it 1,000 basis points. So at that point, we do think that the markets are actually pricing in too much default risk. Even though in the recent months the spreads are tightening quite a bit, the current credit spread is still pricing in a default risk of around 8%, which is higher compared to the market expectation of 4 to 6% this year. So no doubt, high yield default rate is expected to move higher given the more challenging growth environment. We are not expecting default rates to revisit the highs we saw during the global financial crisis, which reached about 9 to 10% in 2008-2009 period. So, and that's partly because the market has grown significantly in terms of size and diversity, and there's also a greater market depth. So we do actually see more local investor participation, and local investors are willing to fund the refinancing activities of Asian issuers. So that's why we still think that the default rates are likely to be lower compared to the global financial crisis. And at expected default rates of 4 to 6%, the current credit spreads do seem to price in excessive default risk at current levels.
So where do you currently spot investment opportunities in Asian fixed income markets for investors?
So like what I've actually mentioned about the monetary policy bias, we do think that the monetary conditions likely to remain very accommodative. So that's actually conducive for bonds. And given that we do expect a flood of liquidity coming from the quantitative easing programs in the G3 economies, we do think that this flood of liquidity will rekindle the drive or the hunt for yield, and this is likely to benefit Asian bond markets because of their mix of good yield as well as quality. So on the whole, we are overweight duration, given that interest rates are likely to remain low, and we are also overweight the higher corporate sector because, as what I mentioned, valuations have remained relatively attractive, and this hunt for yield is also likely to support demand for high yield corporate credits, given the higher yield in nature.
To what extent did you change and alter your portfolio strategies during the last 6 months?
To be honest, the change in portfolio positioning is not so apparent on a sectoral and country level because the changes are made mainly from a bottom-up perspective. So on one hand, we have the trimming credits, which we think that may face more challenges in terms of liquidity, in terms of refinancing ability due to the COVID-19 occurrence. And given that liquidity conditions are more challenged for these companies, we decided to actually pair some of the riskier names. But at the same time, as I mentioned, we do think that valuations have become more attractive, and we have actually tried to increase selective bet on individual issuers, which we think could actually weather through this challenging period. So that we do retain our overall weight in higher corporate, and within this higher corporate segment, we are generally retaining a preference towards Chinese high-yield property while underweighting high-yield industrials. Outside of China, we are having a higher tilt towards Indian renewable energies as well as Indonesian quasi-sovereign.
So this was Tricia Wong, fixed income expert from Eastspring Investments from Singapore. Thank you very much, Tricia, for being here with us today and sharing your views.
Thank you very much.